Assalamualaikum and hello everyone. Welcome back to my channel. Welcome to MFRS 10, and what we're going to do today is to prepare a consolidated statement of financial position on the date the shares were acquired. For your information, MFRS 10 is equivalent to IFRS 10 consolidated financial statement. And our focus today is to do just a basic consolidation example, which is focusing on simple group structure. And we are just doing an example that has one parent and one subsidiary. And this is actually an introductory course to consolidated financial statement. And we're going to start by doing the consolidated statement of financial position. Before this, in my first video, which is on the same company, Happy and Sunny, in my previous video has already prepared their financial statement right after the acquisition of shares. Happy has shown the impact of the acquisition of Sunny in its financial statement, right? And Sunny also has already noticed that the shares has been acquired. That was in my previous example here. So where I have done one example on just the preparation of a separate financial statement, and this is the one that were the result as for the my previous video, which is on the one that you can check down the link. This is nothing to do with preparation of consolidated financial statement. It's just a statement of financial position that were prepared immediately after the parent had acquired the subsidiary. And here the parent is Happy, the subsidiary is Sunny. Now we move on to the second part of it, which is extension to the exercise 1, Happy and Sunny. And what we do now is, before you can complete or doing this with me, I would suggest you to first go to the first video and check that video first, because you need to complete that session before you can start with this session, because this session is to prepare the consolidated financial statement. I'm also trying to advise you again that you should go and refer to example 2 in the textbook, page 336 to 337, so that you have a better understanding. I'm not going to go through with you those examples or whatever things that are in the textbook. That is for your own personal review and also study. So here I'm putting again the statement of financial position of Happy and Sunny after the acquisition of shares. And what we're going to do now is we're going to look at the next step, what should be done. And if you can still recall from the MFRS 10, one of the requirements says that once a parent has acquired control in the subsidiary, right, the parent must consolidate the subsidiary. And meaning to say that the parent must prepare the consolidated financial statement. So here is a separate financial statement of each parent and also the subsidiary without being combined, right? So let's look at the information that you have here. Based on answer D of exercise 1. Okay, exercise 1, answer D is this one. Okay, I'm putting it here. The same thing. You are required to, these are what you are required to do. You are required to compute fair value of net asset in Sunny on the date of acquisition. So the date of acquisition was 1st of January year 5, right? And then the above answer, as I said, was taken from the previous exercise. Second one, you asked to compute the measurement of the non-controlling interest. This is actually things or the step that you need to do before you can prepare the consolidated financial statement. You also need to determine whether there is any goodwill arising or any bargain purchase arising. The third one, you need to present the necessary consolidation journal entries. In this particular example, there is no such thing as intercompany transaction or intra-group transaction yet. And last one is the task or the part that you need to learn for the first time, which is the preparation of consolidated statement of financial position of Happy and its subsidiary Sunny as at 1st of January year 5, meaning that you need to first look at the the step in that is involved before you can prepare the statement of financial position. I'm doing this step by step so that you have a good understanding of the process to consolidate the financial statement. So if you see the first requirement just now, yeah, that is asking you to I'm going to show this a little bit smaller so that you can see both view. Okay, is that you are asked to compute the fair value of the net asset. Okay, fair value of the net asset. What is actually net asset? Yeah, if you can see here, this is actually something to do with your accounting equation. So if you can recall your accounting equation, net asset is actually asset minus liabilities. Asset minus liabilities will give you net asset, and the accounting equation says that equity equal asset minus liability. So if you were to calculate the net asset, it is also the same if we go and find out what is the equity. So net asset is actually equal to equity. So whenever you say equity, it is also the net asset. So equity where? We are talking about equity in subsidiary because you are asked to compute the fair value of net asset in SANI. So when you have the word here, a net asset, right, you would notice that that net asset there, yeah, it should be at fair value. At fair value means at the fair market value on the date of acquisition. So let's see here. I have done this here. This is A. You can see the numbering here. I'm putting the calculation of fair value of net asset in the calculation of goodwill, because if you can still remember the lecture, the calculation of goodwill will make use of the fair value of net asset. So fair value of net asset, if you see here, we are talking about equity. So let us check the equity section in SANI. So this is the only equity that SANI has on the date of acquisition, which is ordinary shares and retained profit. So we're going to put the same thing here, the ordinary shares, yeah, and that is actually retained profit available on the date of acquisition. That is also known as pre-acquisition profit. How much is that? It's the same amount. So 940,000 plus 190. There is no other equity or reserve except for those two. So now you have the first answer, which is the answer for A, which is 1130. So your fair value of net asset would be equal to 1130. Yeah, it is 1130. Right. So that is the answer for your first part. Next, you are asked to calculate. So if you have other reserve, okay, let me just tell you, like general reserve, you may also have items like asset revaluation reserve, or maybe other reserve that relates to the subsidiary. Yeah, that should also be included in the net asset calculation. And that should be at the fair value. Here, no information is given on the fair value. So we take the carrying value or the carrying amount to be the net asset value on the date of acquisition. Okay. Next, you are asked to compute the measurement of the non-controlling interest on the date of acquisition, if any. If you can recall earlier, our acquisition in the in SANI, holding was having 100% shareholding, and if holding is having 100%, that means the non-controlling shareholder or the non-controlling interest, which is the same thing, has none, right? I'm asking this question because in case you might not understand the concept of non-controlling interest. So here, if you were to ask to compute the measurement of non-controlling interest, the answer will be none or nil. Why? Simply because there is no non-controlling interest percentage. However, if you look at the impact of non-controlling interest in the calculation of goodwill, that is actually included in the calculation, right? If you are asked to calculate goodwill later. right? Which is the next task. So there is nil, nothing, right? So therefore, the non-controlling interest measurement there is none. Why? Because 100% shareholding is by parent. Next, you are asked to determine whether there is any goodwill on consolidation. Here, parent acquired 100%. So let's see whether there is any goodwill on consolidation. Right, to calculate goodwill on consolidation, if you can still recall, you are going to take the consideration transferred, right, plus the non-controlling interest, right? The non-controlling interest must be correctly calculated, must be correctly calculated, means must be measured correctly, either using option 1 or using option 2, right? I will talk about that later. And then at a proportionate, okay, this is the measurement of non-controlling interest. I'll be talking about that. And then you need to know there is nothing there. And you are asked to calculate the goodwill. So to calculate the goodwill, you need to find the consideration transferred. The consideration transfer has already been finalized, which is, this is the one. This is your consideration transfer from your previous recording that you have done. That is the consideration transfer. The 130,000. We'll take a different color. Okay, 130,000. 130,000. So now the total consideration transfer and the non-controlling interest will give rise to 1130. That is equal to 1130, the fair value of net asset. Remember, during the lecture, I told you that this is actually A, which is the combination of consideration transferred plus the non-controlling interest. Okay, in your level, you are not going to learn the fair value of previous acquisition. That is not within the syllabus. So we are focusing just on consideration transferred, the first item there. So let me just put a little bit of information here so that you can see things easy. So to calculate the goodwill, what you can see is that you need to first find out what are the consideration transfer that has already been calculated for you, because that was given in the statement of financial position of Happy. The second one is, you can see I put the step here, is to calculate the fair value of net asset. In our case, that has been calculated as the first requirement. The third one is to measure the non-controlling interest. In our case, none, since 100% of the issued ordinary shares is acquired by Happy. So if you go and find the goodwill, you are going to compare whether there is an excess of A over B. So I've put some equation here. If you were to compute goodwill, you need to compare A and B. If A exceeds B, that will give rise to goodwill on consolidation. If A is less than B, that will give rise to a bargain purchase, but you need to do some review for that. And if A is equal to B, which is in our case, A is 1, which is the total consideration transferred and non-controlling interest, the total is 1130. That also equal to the total fair value of net asset. With that, there is no goodwill. There is no goodwill, meaning that you just pay to your subsidiary just the amount which is equal to the net worth of the company, or the fair value of the company, which is 1130. You don't pay extra. There is no premium that is being paid. And the reason why, this is because no goodwill, since the consideration transferred by Happy, the parent, for the investment in subsidiary is equal to the fair value of the net asset of acquiree on the date of acquisition. Okay, let's just do a little bit of revision on goodwill. I have some diagram that I have prepared for you here. Right. Before we can calculate a goodwill on consolidation, the first thing that we need to check is what is the measurement of our non-controlling interest. Recall, non-controlling interest is the equity in your subsidiary company, right? Equity in the subsidiary company that is not attributable directly or indirectly to the parent, whatever that does not belong to the parent, right? That belongs to other shareholders, yeah, either directly or indirectly. These are non-controlling interests. The percentage that belongs to the parent is called controlling interest. The percentage that belongs to the non-controlling or minority shareholder is called the non-controlling interest, which is the percentage. In our case here is 0. So there are two measurements of fair value given or option given. One is it is measured at fair value, or the second option is that it can be measured at proportionate share of net asset. In our case, none, because there is no non-controlling interest. This will only happen if there is a non-controlling interest, let's say 30% or maybe 40% non-controlling interest. So that then only we talk about this. But here I just like to go and do a little bit of review. So when we say measurement at fair value, what does that mean? It means that it will be measured by taking the fair value per subsidiary's ordinary share. What is the fair value of the ordinary shares in the of the subsidiary on the day of acquisition? And you need to times with or multiply with the number of shares held by the minority shareholders. Let's say the minority shareholders is 100,000 units, right? And let's say the fair value of the ordinary shares on the date of acquisition, the one that relates to the subsidiary, is 2 ringgit. So if that is the case, it becomes 200,000 to be the measurement of the fair value. But we will go into that in other example. Another one is that if that is not the measurement, but here it is moving towards fair value measurement. So this is more likely relevant, but this one is still being allowed to be used under MFRS 3, right? The standards allow that to be used. And therefore, you have fair value of net asset here. Fair value of net asset means you are going to calculate what is the net asset, just like this, 1130, for example, and you are going to multiply with the percentage of shareholding. In our case, we have no percentage of shareholding by NCI. That is why there is no non-controlling interest here, because there are no shares that are held by the minority shareholders. Do you know that the measurement of NCI will affect the way goodwill is being measured? So if the measurement of NCI is at fair value, you are going to measure goodwill using full goodwill method. However, if the measurement of NCI is at proportionate share of net asset, you are going to measure the goodwill just related to the parent, which is what you call partial goodwill method. Okay, what is this partial and full goodwill method? We'll talk about this in our next video. But here is where the non-controlling interest is measured at fair value. Measured at fair value means fair value here. Fair value of the ordinary shares in the subsidiary company multiplied by the number of shares held by the minority shareholders. That is called fair value. You can see that that is related. That's why I put an arrow here. And then what happens if the goodwill is measured or being said to have partial goodwill? This is because if the company decided that they will measure the non-controlling interest using the second method, which is the proportionate share of the net asset, right, of the acquiree. So you take the percentage being acquired by the by the non-controlling shareholder, multiplied by the fair value of net asset. So here none, because there are no percentage acquired by the non-controlling shareholder. So if you measure using partial goodwill method, NCI is measured at proportionate share of net asset. Goodwill will only represent the parent share. However, if you measure, or if you as an investor or as a parent measured the goodwill of acquiring your subsidiary using fair value method, the goodwill that you calculate will represent the full goodwill. Full goodwill means it will show how much is the share of you as a parent and how much is the share of goodwill by the minority shareholders or the non-controlling interest. That was a quick lecture for that part. Okay, I'm done with that. Next, you are asked to do no goodwill. Okay, no problem, no goodwill. Then you are asked to present the consolidation entries. right? This is not the acquisition of subsidiary that were done in the separate financial statement, but this is to do the consolidation, meaning to say that once it becomes together, or when the financial statement is being combined, whatever things that should be cancelled off, meaning that investment in Sunny, for example, this one will need to be cancelled off because now Sunny is part of the group. Whatever that are related to the group may have to be cancelled off. Whatever. Here what we're going to do is we're going to eliminate the cost of investment against the share capital and existing reserve. Remember, we acquire this in return. We issue shares, right? However, the acquisition of the shares in the subsidiary will give us control, and therefore we are going to combine the asset, liabilities, and equity in the consolidated financial statement. So the consolidation journal entry here, if you look, what you need to do is you're going to eliminate the ordinary share capital in Sunny since you have acquired the shares. So all 940,000 will have to be eliminated. What you will report is just the shareholding of the parent. Only the shareholding of the parent that will be reported. The shareholding or the shares that you have in the subsidiary will have to be eliminated. So if this has a credit balance, now you need to go and debit. So you go and debit the ordinary share capital in Sunny, not the one in Happy, the one in the subsidiary Sunny. The second one is that also you need to also go and adjust the second item, which is your second item is equity, right? We are talking about equity here. The equity here in the subsidiary, the first one is because the shares acquired, and the second one is the profit that you have here. The profit that you have here is the one stood on the date of acquisition. So therefore, that has to be eliminated, right? Before it is here, that does not belong to the parent, because that is when the Sunny has actually generated even before the parent has taken over. So this shouldn't be the case of belonging to the parent, right? So 190,000, and you are going to also eliminate the investment in subsidiary because now subsidiary will become part of the group. So you are going to credit the investment in subsidiary. So once you do that, that is the what you call consolidation journal entry on the date of acquisition. So 1130. So you eliminate. So when you eliminate, this will have impact in the consolidated statement of financial position. At the moment, this is the only entry that you have because we acquire the subsidiary on the date of acquisition. There is not many transactions yet. So that is the consolidation entry, which is done in the memorandum account. The adjustment is done by parent, not in the books of parent, not in the books of subsidiary. That is done for adjustment purpose only. Okay, I'm showing you two alternatives to prepare the consolidated statement of financial position. Okay, the first item that I'm showing here is for you to first put whatever you have, right? Okay, you can see that I'm copying what I have here. I actually copy what I have here and I put here because this is the answer part. This is the question section. There's a border here. This yellow border is separating between question and answer. Okay, you have this. So what you need to do is, the first step is for you to combine. If you are doing it through worksheet or you use Excel. But in exam, we don't use Excel. But I'm just showing you in case you use Excel. But we're not do this. This is just some introduction. So you combine. When I say combine, means add the asset to the liability. Just add everything first. Don't, of course, the formula can do it for you. So you add. So add what is in Sunny plus what is in Happy, right? You add all the items that you have. So now that is what you do, right? So do the casting here. Do the casting here too. and then you can add a cross. The next one is to eliminate the cost of investment, because you say debit only share capital. So here is the elimination section, which is to eliminate things before you report what is in the group. So if you see here, first it is 1130. What you say here, if you can see here, this is credit. So investment is debit. So once you credit it because of being eliminated, right? This one. Okay. Okay. So the result here will be nil. Why nil? Because there are no more balance, right? No balance, zero. So the non-current asset, there are no adjustment whatsoever. If you have any intra-group transaction later, this will have to be adjusted. But we do it in the exam style format. But this is just to have you, let you have some idea of how do we do it in worksheet. So here we just add, no other adjustment. The same thing for the current asset and bank. You just add them because there are no adjustment that need you to go and credit or debit to the bank account. What you credit on the asset is what you deduct, right? Okay. Now you can get the total. The total will be this total here. And the total is 4852. Next, we go to the our equity and liability section. For our equity, I was telling you earlier that what you will report is just the parent. The one in the subsidiary will have to be eliminated. But when we combine, this is 3890. This is what you combine. Okay, that is what you combine. This is what you eliminate. Sorry about this. So 940,000, you go and debit your share capital. So what meaning that 3890 minus 940, and that will give you the figure 2950, which is just the one of parent. Remember I told you the one in the subsidiary company must be eliminated. Same thing will be done for retained profit, because we do this on the date of acquisition. Most of the time, the preparation of consolidated financial statement will be done on subsequent date, right? On subsequent date means not on date of acquisition, but any date, maybe after a year, or after a few months, after several months that you have acquired. This is our example showing that we are doing it the day we acquired, right? Next, nothing to be deducted in the liabilities. Now you can total up this section and you will get exactly the same as what you have there. And if you, that is to do it through worksheet. If you are doing it through exam style, you're going to do something like this. Yeah, you're just going to write the same title, Consolidated Statement of Financial Position of Ketupat and Subsidiary Lemang as at 1st of April year 5. This is for exam style. I'm just giving you two options. So the figure that you will show here is whatever you have here. Okay. Right. This is the one here. This is the one here, 804. 804 is the bank balance. Is it? No, that is the current asset. So 804 is the current asset, yes. And then bank balance is 1218. You total up that. It should, meaning that you just copy and paste whatever you have here and you put here. So it should be the same. Okay, it should be the same here. But this is, but all the workings will be done if you have a lot of working. Normally in exam style preparation, you will do all the workings in each line that you have here. And for the share capital, it will just report the one of the holding company. We'll learn more adjustment on this later. And for the retained profit, just of holding, because there are no share of holding in the subsidiary company yet. Holding will have some share of profit in the subsidiary only if that relates to post acquisition profits or post-acquisition reserve. Here, all the reserve available in the subsidiary, 190,000, is the one that is earned by the subsidiary before the acquisition of the holding company or parent company. That is why it is not added and it is being eliminated. Non-current liabilities, you are going to add. No matter you acquire it 100%, no matter you acquire it 70%, 80%, or maybe just 60%, you are going to consolidate the asset and liabilities, yeah, here, 1.7, right, in full. You are not going to consolidate, let's say, 700,000 times 80% because you acquire 80%. There is no such thing. The standards say once you acquire it and got a control, you need to consolidate the asset and liability 100%. Remember that. It must be 100%. No matter your control is not 100%, is 90, 70, 75, or whatever the percentage, as long as it is a control, you can prove that it's a control, it will be 100%. With that, I thank you for watching. Yeah, that this is just a basic statement of consolidated statement of financial position. We'll go with the one which is still a basic one, but we will focus later on goodwill and the measurement of non-controlling interest. With that, I thank you for watching. I'll see you when I will see you. Assalamualaikum warahmatullah, and have a nice day ahead.